So, we had false positives before. I mean, it's not. But we have like this triple. Can you see my screen?
Yeah. I see your screen. Yeah.
This S&P chart is a pretty important.
It's broken, right?
Well, no, it's not. We just have this triple bottom here. It keeps trying to test this level here of 356, right? 356.
Yep.
357. 357. That same triple, and we bounced off of that.
Yep.
And we're just basically back at the top of this range again at the end of today. I wrote this what we're going to be talking about earlier, like yesterday or something. So I'm gonna
you put it yesterday. Yeah.
Yes. So what I'm gonna do is I'm gonna trace this out just because it's so close. It is so close to. Let's do one size of one. See how this maps out. Okay, but the important thing for us is we were watching this level right here. And let's look at this level here. Okay, that was our June lows, and we're kind of bouncing off. We're back at the top end of this range again. So don't get too excited because we have this possible going down next, right?
Yeah.
But if we can break out of that, who was the one that said no? Joe. Joe said, "Oh, don't be so optimistic." Because what if we break out of this? Then the thing is, we're lining up right now with the earnings season.
This is what I see from the last 3 days, right?
Mm-hmm.
We have been all green, pretty solid green.
Yeah, we had. But we're in a trading range. I mean, if we're just right. Look at we're at the top of where we went down before. So we're kind of in this trading range of going up and down here. So, but every stock we're following kind of follows the S&P. If we have any good news come out this week, what I've been doing for during this whole thing, I've been very, very simple. I've been just buying a little bit of Google because the earnings estimates of Google are not going anywhere. It's like every one of the analysts that comes on TV says, it's a fair value. It's growing at 13%, pretty much consistently.
I bought Google too. Yeah.
And if it goes down from here, I'm buying more. So
I bought it at 125, then I bought it at 99.
Okay. So what the thing is, when you're in this environment, if you have a portion of your portfolio, you got to commit to like a long-term buy and hold compound.
Yep.
And this is what I did was on this stock market presentation. You see. Okay. Meeting. What I did is I broke down Google. Alphabet. Okay. This is the important thing about compounding stocks. I mean, it isn't every day that they go on sale. Right now we have Google at like 15 PE. And the last time it was 15 PE, it's never 15. Look at all these PE ratios, low and high. The low, going back to 2012, is maybe a 16 PE, way back in 2015. And we had a 15 PE right now. But, so you have to look at, historically, what is it traded at? And it's still beating the numbers now. There's people reducing the estimates a little bit. But in environments like this, where we know we have, let's look at we know we have a catalyst. We have earnings coming out for Google. Yeah, for Apple, Google, all the tech stocks. If they even beat by a little, or if they, that could be the catalyst, that will break us out of this downward trend. And we know probably the Fed's going to be done. That's another catalyst. They're going to probably be done. They have a Fed meeting. Maybe they'll raise interest rates a little bit more, and then they'll say we're done. That's a catalyst for a Santa rally and possibly green for the end of the year. So I'm thinking, Google has this everyone's going to go whenever things are back to normal. Everyone's going to like jump on that. And tech stocks, they recover before the rest of the market. So we have to. One thing that Walter Deemer said, he basically says you got to time 3 months before the end of the recession. That's whenever the stock market will recover. And so that's our basic task right now, is just to figure out when this recession is going to be over, when it starts. And for me, I'm buying and holding, and just kind of buying things that are going to be my long-term compounders that are going to be most reliable over time. And whenever I'm looking at these, that's not the one I'm looking at. Okay, whenever I'm looking at the numbers for some of the stocks we're following, like I concentrated on Nike and Apple this week. I'm looking for stocks that are consistently growing like this in a row. They might have a down year like this year and maybe next year because of a recession, but they're consistently growing. They got this formula where they can grow 13%, and the revenue's increasing. The important thing is the PE ratio. If we look at it over time, it is always traded at premium. It's only growing at 13%, but it's always traded at this premium level, and it'll trade back at that level when things get back to normal, maybe middle of next year, end of next year, whenever the Fed starts reducing the rates. I don't know. But you have to look beyond this time right now where we're at, and is it that bad where they've lost their business model? Maybe when the government starts cracking down on them, that could end this, the run they're having. But right now, what I'm doing is I'm just kind of looking at, if you're having any missing pieces in your portfolio, because whenever you have, maybe you're putting together a portfolio, you want a portion of growth, you want a portion of financials, you want some, a little bit of every one of these sectors. So if we look at our stochastics for this week. I didn't open them up yet. Hold on. If we look at our stochastics for all the major indexes. Oh man. Oh man, that didn't come through. I should have.
You have to maybe double click.
We can kind of look at last week's. It's not the end of the world to look at last week's. Okay, so we look at the still the same chart basically. If we look at our different sectors, of our portfolio, let's look at the indexes, the different sectors. It's basic materials, communication services. Healthcare has been holding up, so we don't want to start accumulating those things right now because they've been outperforming. But the stocks like the financial sectors, they've been really in a downtrend. And there are stocks right now we're going to go over later on, Berkshire Hathaway, for instance. That's an example of a financial, and it's definitely under pressure with the rest of the stock market. But if you don't have a certain amount of financials in your portfolios, you got to start putting together some of those before they run. Right now, Bank of America, they came out with really good numbers, and the banks are coming out this week with numbers. So, JP Morgan was last week. But when these sectors are down, you have to start dollar costing into them. And if you don't have any tech right now, if you don't have any exposure to growth, this could be a time to put a little bit into maybe the moonshots or the stocks that are going to consistently grow over time. Because right now everything is pretty washed out. Yeah. That doesn't mean it can't be more washed out. We don't know when it's going to stop going down, but we can see through this, through time like the last 10 years, if stocks are consistently going up and they're on sale for whatever reason, this is the lowest PE it's been in 10 years. It's probably lower than that because they have cash. Look at the cash they have right now. And if you subtract the cash, their PE is like 15 right now for Google. So, and we have a fair value of 103, which is a little bit more. It's maybe 5% more for CFRA, but the fair value for Morningstar is 169, and that's like almost half off where it's trading at. So they missed their Q2 expectations, but cloud growth is impressive. And so one thing that they're saying is they lost 3.7% for the stronger U.S. dollar. Every multinational we know is going to say that the dollar is affecting their earnings. 3.7 for this, and I'm sure Nike and Microsoft, Apple is going to say the same thing. So that's just like it's a mulligan. It's something you got to ignore for now, because next month or next year, the dollar will be on our side. So it'll be 3.7 gain on their revenue. But let me see. So they're still growing it. Google's still growing around 13% a year for their revenues, and I think it's just one of the best. It's one of the most commonly held stocks in the major mutual funds we're following. Almost everyone has a little bit of Alphabet in it. But at some point in time, it will, their run will stop. But we're just looking at the estimates right now, and we're looking at the estimates. Here's Google's estimates for the next couple of years. It doesn't show it here, but I calculated it. It's still 14 to 16%. We're watching this because they could have a bad year or something like that, and we have to be ready to not pay as much. But it's pretty consistent. So if you have a stock market that's selling off, even if it sells off more from here, let's look at possibilities, things that could happen. We're in a definite downtrend. Look at that. We're in a downtrend. We're getting towards the end of the year. We could make another big crash like this. If we go down 20%, like maybe Jamie Dimon says, we just got to be ready to wait for that, because a lot of times that crash, it recovers within a month or two of the crash. And you have to be willing to dollar cost a little bit into things if that ever happens. But we're like at a point right here where we're bouncing off of this low 3 times. Mm-hmm. So that is really powerful. The 3 times we hit that. If you count this, possibly, we're bouncing at that's a support level. So if we, so right now we're kind of at a top of that downward trending range. Let's hope we break out of that. Otherwise, we'll go back down to here again, and maybe bounce 4 times. What's going to take us out of this is probably earnings. So we have that coming up this week and next week. The things that made the stock market excited today is the Bank of America had really good earnings. Let's look at Bank of America. Finance. Let's look at Yahoo Finance, the top news stories. Okay, so I was trying to get to Yahoo Finance. Okay, so the we have a lot of cash on the sideline right now. So cash is it's pretty dangerous for the average investor. They got out of the stock market when it was going down. Like a typical person who's like a momentum investor, and they were betting in some of these really poor stocks like Best Bed Bath and Beyond, GameStop, and that. As soon as you see the stock market going down, you got to get called out for your positions. You're going to exit, and that's when the professional investors start buying. And so, whenever the stock market does go up, like it does today, that's the retail the professional investors. That's like feeding the ducks, they call it. So, the professional investor knows that we're in this downtrend. We're at the top of the downtrend. They're not going to get fooled. They're basically making money off of the sucker who's going to be the person buying. But for a long-term investor, I'm seeing this as, just the normal market volatility. You just have to. That's part of being a professional investor. If you do this for a good portion of your retirement or something, you have to be willing to put to buy and hold through this environment. So look at this right here. Okay, we're actually almost at a point where we're halfway overbought. So every time we've gone through this halfway overbought it went back down. So we're at that spot right now at the end of today. So let's see if we go up to this. If we go up to this spot where we're overbought, maybe earnings will take us there. Otherwise, we're in this pattern, this short-term pattern. We go halfway overbought, the market loses conviction, and we go back down. There's a very good possibility we're going to get some earnings reports that are going to be super bad, and I think what people are going to be saying is it's not as bad as expected. So I'm thinking companies like the big tech stocks, they're probably going to be doing better than feared. So I think that's the thing.
They're also expecting them not to do great in earnings, right? So even if they don't do great, they do average, they are still, there's people will be like, oh, right,
Right.
they will be okay,
Let's look at the emotional. We always go through this every week.
Yeah.
Emotional roller coaster of the average investor. Okay, so we've been through this. We're basically at the beginning of this week. We're down to despair. I mean, the people, the weak hands, the ones that don't have a diamond hand mentality, they've already sold. And
Yep.
just think if there's 20% of the market that's temporary, they buy and sell based on if it's going up or not. Momentum investors, they've already sold and they're out based on that. VIX is 32. Everyone's scared on TV. Now they have to get back in. You have a lot of cash on the sideline. That's gone, and we have the end of the year seasonality. We know is the last 3 months of the year, the best quarter of the year, and we have Christmas, and that feeds the first quarter of the year. So we have the best earnings time of the year for retail and for Apple and for all the big tech companies because people advertise for Christmas, and everyone knows seasonality. If we look at let's look at Google's earnings. You can see that Q1 for most companies is the best quarter because you have Christmas, the Christmas season. So you have advertising, the advertisers advertising around Christmas. So that all shows up on the first quarter. So that's why the fourth quarter is, there's more activity economically in the fourth quarter than any other quarter. But whenever you're looking at these quarterly earnings reports, for this is E-Trade, you have to look year over year. So you have to look at the first quarter of 2021 versus the first quarter of 22 versus the first quarter, and you have to make your own little chart going up or down that way. Because everyone knows that these second quarter, it's not going to be as good. Who's buying iPhones for presents in January? So that's why when you look at this, you have to look year over year if it's going up in that straight line. And the great thing about Google's earnings is they're pretty consistent over time. They had this, the problem with the pandemic, of course, with everyone else, but and you allow that one-time thing. But in general, for compounding stocks, you want to buy stocks that are consistently over time, and you can look at multiple ways. Like this right here is the amount of free cash flow over time. You want that to go up in a row and to be consistent. So that usually means they have a consistent business model. And whenever there's sell-off like this, you have to look, well, are they trading below the multiple? This is the multiple that they've traded at in the past. So you have to look, well, they traded at 11 PE at the worst of the pandemic. And right now, they're if you X out the cash, they're trading around that right now. So for me, a long-term investor, I like to look for, great stocks that are selling off that have this consistent earnings over time. Okay, this is actually Emerson Electric. There's an article I went over here. Let me go back to the beginning here so I don't get over my skis here. Okay, so the beginning is right now we're in right in the middle of earnings season. We started with the banks. The banks are always the first to come out. They're going to tell us basically in a recessionary time, Jamie Dimon says we're probably going to be in a recession. So they're holding on to money and not investing it, and that means they don't earn as much money as they normally would. So that's called loan reserves. They're holding back money for defaults. So when people don't have jobs, when they lose their jobs, when they don't have as much money coming in, and they have to spend more on things, and that causes defaults. So they have to have less money for investing, and that makes their returns worse. So right now, Bank of America said that they did really good on their earnings. And
I think Bank of America did good today.
So let's see what Bank of America, and that's a good.
They went almost 5 or 6% today.
Yeah, I didn't know that. The reason why the banks are important, they give you a really good insight. BAC, let's see. They give you really good insight on the consumer and how strong, the spending is going to be. And Bank of America basically said we have. This is what did they say? Banks report robust earnings. Okay. A rosy consumer outlook. That's like the biggest line of today right there. Because if the consumer is still spending, that's going to allow the economy to keep going and not go necessarily into recession. So when these banks say these things this week, that's going to say, well, maybe they're spending money on iPhones, and maybe the Apple's earnings isn't going to be that great. So it's like a snowballing thing. So if they so the banks are going to give us that hint. That's all. They're always the first to report in earnings season, and then we're going to get these canaries in the coal. We already have some people there's some companies that have already pre-reported that they're going to not meet estimates, and usually if you get this far, into the first week of tech reporting, then there's a good chance that they're going to at least meet their estimates. Otherwise, they would have pre-announced something. So we'll just watch and see. That could take us down lower in the S&P, or that could take us, break us out of this. So I think it's going to break us out of it because we have historically, that's a lot per bank here, but if you don't have any financials, if you don't have any financials now, now's the time to start looking because let's look at the XLF. Now, I have financials just for diversification. I have JP Morgan and Wells Fargo, and you get a dividend from them. It's pretty consistent dividend yield, 2.2% average for the XLF. But let's look at you can't get a worse chart than that. Look, lower highs, lower lows, but it's basically baselining right here. Look at this right here. So right here, if we have any hint in our meeting notes, we look at these, any hint of any of these catalysts, some of them are really important. Like, if inflation is getting better, if we have too much of an oversold market, which we had recently, anything with Russia that's good, anything with Chinese, any of these things happen, that'll break us out of these things. But right now we're still at the I think what they say is the bond market is the tail wagging the dog. So we still see that the bond market has been up 1% since last. I mean the rates, it's up 1%, 2% since last week for the 2-year. So the more this rate goes up, the more the Fed has to raise the rates. So we're just keeping our eye on these for our short-term understanding of what's going to happen with the stock market. So this hasn't been in our favor in the last week. We just had an oversold condition. We're bouncing off that level on S&P. And let me see. We haven't had any. We had Bank of America have the good news today. I don't know. I'm seeing progress in Ukraine. I mean, I'm seeing them winning some wars over there, and Russia's running out of money, maybe. I'm not sure. But that's what it seems like, doesn't it?
They should definitely. They're already poor, and they're getting poorer and poorer.
Yeah, I don't know what's going to happen there, but it's looking better. So that could be why, stock market might be, getting a hint that with that. But I'm not an expert in that. I don't know. But the 2-year, 10-year is still going up. That's not good for the stock market. And Chinese said they're not going to back down on Taiwan yesterday. That's not good. So the safest, right now, if you don't have any money in the stock market, you got to think about your overall plan, where you want to be, and, how much do you want to have? How much risk do you want to take? Because right now, some of the highest quality companies are on sale 20, 30, 50% or more. And you have to say, well, what's your time frame? And, are you willing to handle some volatility? For me, volatility doesn't mean anything. I mean, I'm not going to sell something I bought in 2008 now. It's unless the company is fundamentally, and these numbers change that we're watching, but everything's still signaling, that we're still growing. Okay, so I'm going to look at a couple of things. Hold on. Growth rate calculator. I like to review this every now and then. Hold on. Okay. This is a simple calculator that says, you're starting with 100,000, you're growing at 3%. How much are you going to have? This is 2022, 2022, and this is retirement. And you have to say, well, if you grow at 3%, how much are you going to have by the time you want to retire? And if you want to crank that up and say, I want to retire like in 5 years, how much money do you need? 2 million by 236. Then you have to invest in things that are growing 25%. And so you have to keep in mind where you want to go, what's your comfort level, and you have to be willing to scale back whenever you get towards your goals. And right now, if you have a goal of making in 10 years, if you want to make $5 million, you gotta make 70%. There it is. You got your $5 million in 10 years, but you gotta have to be super aggressive right now. And that could be buying a very conservative stock. Maybe Google's on sale for 1/5 of its value. Then you can definitely reach your growth rate of 70% because it's trading at a discount. So we like to keep track of the discounts that stocks are trading at, and that'll allow you to help you meet where you're going with your investments. Okay, so let's look at back where we're at here. Right, the safest stocks. Let's look at what's going on in the stock market. We got a little bit of time here. Yep. Okay, it's the percent gainers. We know the banks probably are doing good today because of the Bank of America report.
Netflix, I think Netflix did good today. Netflix and Tesla, they both did good.
Okay, Tesla, Tesla's down a lot. You know a lot about that. I mean, they are, I don't know if it's because of, let's look at that.
Is the Tesla got down just because it's, I think the overall market came down.
Is it the Twitter problem?
Not the Twitter problem, no.
Look at this.
Musk said something. He said something, what did he say? He said that, I forgot. Something he tweeted and it went down, but then it went back up, went up 7% today.
Look at this chart right here. If you're interested at all, ever, in Tesla,
yep,
this is like the perfect time to buy it because look, we have support here. That's at 204.
Yeah.
204 right there, 209. And then you have all this bounced.
Yep.
So anyway, that's a really good support. That's a good example of a support level. I'm not sure about let's look at the fundamentals.
I don't have stocks, but I only do options and then make money and get out of it.
Oh, yeah.
And this year Tesla is the only one which has given me 100% money.
Oh yeah.
Yes.
Wow, that's awesome.
The rest all bailed out. But that's still Tesla saved 10% for me compared to what like compared to what losses I have. So
let's look at Tesla.
Tesla will stabilize now after this bullet. I think it's not going to go crazy. But the problem is Tesla has an earning coming up, and they are already predicting that it's going to be a really good earning.
Let's look at Tesla. Just what the estimates are for this. It's been overvalued, for as long as we've been watching it, but it sells at a premium. Like Netflix is an example of a stock that always sold for a premium until they missed their numbers one time, and then it sank like a rock, right? So let's look at this. Okay, so let's look at. So from 2021 to 22, they doubled. So that's 4.09 divided by 5.9. So they're growing at 30% this year to next year. 5.91 divided by 7.15. 20% after that. 7.15 divided by 7.6% after that. Okay, so let's say 20% in the near term. So 20%, and we look at their 34. That's where they get PEG ratio of 1. If they're growing at 20%, you divide PE, which is 34. Let's do that. 34 divided by, maybe they're growing at 20% now, is 1.7. That's where you get this PEG ratio of 1.5. So they're still, overvalued by 1.5. So if you divide the price 219 divided by 1.5, 219 divided by 1.5. So they should be trading at like 149 if they're trading at their growth rate. I think we were saying way back whenever stocks are in free fall, like, people are scared now. We have fear in the market. It's better. We have that fear gauge indicator. It's total fear. It's extreme fear. Stocks usually trade down to a PEG ratio of 1 if they're a quality stock like Tesla. And that's at 146. So let's say 140. No, that's like 146. The worst of the pandemic, I guess. Where were they? They were trading at worst of the pandemic. Oh, they were down to nothing. 33. Wow, they were at 33. That's when you were buying it, Shook.
Yes.
Wow.
At that time I had it and then I sold it and had it and sold it. That's how I did.
Yeah. So right now, it's short.
But I wish I would have kept it for long. I would have. I'll tell you this: it split out first it did 4 times or 7 times. What was that? The first split was 7 times, right. And then 5 times and 5 to 3, right? So 15 times, and I sold Tesla back then for $300. So times 15 to $4,500 style.
Wow. So
I bought it for $80 back then. So
wow, that was the buy of all time. I think that was really great. Now, Kathy Woods, she saw the potential in that. I mean,
she keeps buying it. She kept
buying
up.
It.
Yeah, she thinks it's going to bounce back.
She was right there. We had a talk about Kathy Woods last November. We said is she a
no, she's very aggressive.
She's very aggressive. But we said, was she a loser or a winner? And she was investing in 10 years down the road, and those kind of stocks didn't do good, and she lost like a good
Kathy started investing last year, right? And then year before when she came into picture, and now at that time all the stocks were on peak, and every stock you put finger on, every stock was going up,
right?
So she bought Tesla, and then I'm not sure how much she sold it for, but man, her most of her fund has Tesla. That's a little scary.
Yeah.
But I think she used to have some Nvidia and all of the stocks as well.
Right. So I think it's kind of out of scope from what we're doing, but it did go. It did go up today. It's like a bounce. But if you're a long-term investor and you know that its fair value is about 150, and you're willing to take that hit in a really bad market, be willing to double up on it whenever you get done at 150.
Yep.
And because that's where we'll stop, I think. All right, so look at the rest of what's going on. Amazon
It's good, yeah.
did good. I think whenever the Bank of America said the consumer is doing really good, then that's perfect for Amazon. That's a good portion of their business.
Yeah.
So,
and I think Netflix went up because I think their ad, the idea that they had for that $6.99 ad thing, is going to work. Even though most of our people who in the stock meeting, they don't agree, but I think it is going to work. People will like, okay, hey, it's okay, it's 5 minutes ad, I'll go do some quick work before the movie or the series starts back, which is fine.
Right. Look at the earnings estimates for Netflix. Okay, that's not that bad. They're struggling this year, but they're once they get that in gear with maybe the advertising, then it starts kicking in. Look at from this year to next year, it's not that great. Divided by 1.69. Wait, 10.07 by 10.69. It's growing at 5% this year to next year.
This is Netflix?
Yes. Is it?
Okay.
Okay.
Yeah.
Yeah.
It is.
10.69 divided by 113.26. Okay, 20% after that, and then 113.26 divided. Okay, 18% after that. Okay, so it's going to have some sluggish times between this year and next year, and then it's going to grow 20% again.
Yeah.
But if you let's look at the statistics for that, just for fun. The Netflix, just to see what it's like. The statistics. Okay, 20. Okay, so right now it's only growing like 6% this year. So maybe that's why it's a PEG ratio 2. That means Yahoo thinks it's only growing at 10%. So that makes sense. So right now, according to Yahoo, it's only growing at 10%, their earnings at 10%. And they have great numbers. Just think of what their business model is. They don't have product. They don't have inventory. All they do is sell, their streaming service. They have residual income. Every month, people pay their dues. So that's a certain amount of consistency in earnings. So they don't have to have an iPhone upgrade every week to make their earnings.
Which one is this? This is
Netflix.
Netflix, yeah. That's what that's what I was thinking.
So this PE is 20. I mean, in 2 years it'll catch up where it'll be fair value. So we see that they're going to be meeting that 20% growth in 2 years. For a long time, they were trading at like a PE of 150 or 200, or it was nuts. But they were growing. But as soon as they stopped their growth. Their subscribers, stopped growing. They took a hit. That's an example of what could happen to a Tesla. If Tesla doesn't meet their numbers, they could tank down to their PEG ratio of 1, which is 149.
Yep.
So that's why you have to make sure if you're overpaying for a stock, overpaying meaning it's over. Like right now, Apple is trading at a premium. I'm not sure why. It's Apple. Let's look at Apple. Because they have a residual income. Whenever you have like consistent income like Google or Apple, you trade at a premium because you know that they're going to have a certain amount of earnings consistently. So it's PEG ratio of 2.5. So that means they're only growing at like 8%, and they're trading at a PE of 22. So that's an example of stock that's currently overvalued, and if you buy it now, you have to be willing. Let's look at 142 divided by 2.56. So in a really bad market, Apple will trade down to $55 a share because it's only growing right now at like 7%, their earnings, if we look at the E-Trade. But it's a consistent 7%. So you have to be, and they could ramp that up from 7% once they get a new product. And they do that every 6 years or so. Let's look at Apple. So good companies always invest for the future. Let's look at that. Their earnings estimates. Okay, okay, they're still growing. We'd like to see this going up in a straight line. Let's look at 6.10 divided by 6.44. That's 6%, 5%. 6.44 divided by 6.88. 7%, or 6.88 divided by 7.43. 8% ish. Okay, so
pretty consistent, yeah.
So it's consistent. But if you look at, like, whenever I was looking at Apple and the other stocks like Google, I always go back to that long-term chart like this. You look at, over time, they're pretty much going in a straight line. You have earnings going up. You have price to earnings. Right now, Apple is pretty much at the top of where it's been in the past 10 years. And stocks actually, like, it was trading at 11 PE back when I was buying it. And I saw it was growing. I saw the iPhone 6, being this greatest thing, and people were going to upgrade to it. And that was my theory back then. But right now, it's trading at double that multiple for the. So it's pricey right now, but it's like a safe haven in this kind of environment. But you always have to look at these numbers over time just to see where it fits in, and if you're overpaying or underpaying compared to its history. I'm going to go back and go through some things just so I can. Okay, so last week we were mentioning this level of support, how powerful that is, and we bounced off it again just today, and we're up at the top of this channel. So with bad earnings, it's basically simple. With bad earnings this week, we're going to go down, and with good earnings, hopefully we can break out of this and pretty much go up to the top of this channel. Because if you look at the S&P, let's look at the S&P chart. Where is it? Okay, we have two channels right now. One is a long-term channel. This one right here, we have higher highs, lower highs, lower lows, and the top of that channel is around 400. So we could go up to 400 and still be in a downtrend. And you have to make sure you don't get too excited until we break out of this. If we set these. Okay, now there we are. So this the long-term trend is like this, and this is the short-term trend, like that. Okay, so if we break out of this right here, then there's a very good chance that we go up. Otherwise, we go back down to here. So we'll see what happens on earnings this week. A dollar has been pretty much stable. It hasn't gone up and down a whole lot. So it's up just a fraction since last week. But if this starts going up, all the multinationals are going to suffer. Google had a 3.7% earnings hit because of the dollar. And the more this goes up, the more multinationals are going to hurt in their earnings. We mentioned these major levels. These major levels in the S&P, we just have to watch this. The level we bounced off of today is that level we've been watching for a while now. 12% below that is our next level of support. And if we go back to the COVID lows, which I don't think we would, but if we do, that's 20% below where we are at now. And that's what JP Morgan says if we go into a bad recession, we'll go down to. So we're still up in the Treasury. That's not good for the stock market. And the fear of greed we're extreme fear as of this morning. So these are all contrary indicators. Whenever people are fearful and people are selling things off, that's the time. We have a lot of cash on the sidelines, so there's going to be a fear of missing out. And people will say, oh man, the stock market's going up and I can't miss out. And then everyone piles in. And that usually happens towards the end of the year. Right now we're still in the October, which is kind of, we're still getting earnings coming out, which could be good and bad. VIX is still at elevated levels, 32. That's the panic crash kind of level. It'll probably go down at the end of today, but we're still at an elevated, people are fearful level. it could be totally affected by the earnings this week. Let me see. We're still oversold as of this morning. And we're still fearful, extreme fearful, and we're actually going into the last quarter of the year, which is very seasonally great, positive. So I'm expecting at least us to go up to 400. If we look at the S&P, in a good earnings environment, we're definitely going to go up to hit this level of 400 because we're in this downward trend, downward. The next stop very well could be this. We go up like that if we have good earnings. Let's hope we have good earnings. Let's see what's next. Okay, I think we're almost going to be out of this. We're keeping this picture in mind because sometime in the future, the Fed might be reducing the interest rates and providing liquidity into the market. We didn't really know what to do with it way back at the pandemic time, but the next time they start adding to their balance sheet, buying bonds, and reducing interest rates to stimulate the economy, we'll know, it's going to be one of these bull runs. And we'll watch out for that. But right now we're still contracting, and that could cause us to go down 20% in the stock market, but that wouldn't necessarily mean the stocks that we're following are 20% less valuable. It just means that the stock market goes down and every stock goes down with the stock market. What I did was I went through, there was an article, I went through Google just for kicks, because whenever you're in the market that's going down, you have to check in on all your investments just to make sure the estimates are still decent and they're not dropping off a cliff or anything. And Morningstar and CFRA did some nice reports on this. Morningstar said they mentioned that they have a negative 3.7 hit for this quarter based on the strong dollar, and every multinational have that same problem. Their revenue is up 13%. They're still growing around between 12 and 13% consistently. So they think that their advertised everything is pretty much intact. If there is a recession, then they're going to be flat for a year, and then everything will pick up after the recession's over. Okay, so I did a quick search on, I already mentioned, okay, Alphabet is supposed to be a fair value of 169 according to Morningstar, but the CFRA thought that they're basically fairly valued where they're at. There's two different opinions, but I think with a company with a lot of cash in this environment, that's a lot more valuable than, and if they're a consistent growing company, that adds to the value. But it's consistent with what we've seen in the past when we looked at this stock, so nothing's really changed. So the lesson learned in this environment is, if you see a stock that's pretty much all the numbers are staying the same, you have analysts on TV saying this is fairly valued stock, and you have every mutual fund in the world owns a portion of this, it's a very good possibility that it's a long-term compounder that if it goes down from here, you just kind of buy a little bit more. So it's around fairly valued right now, and the way to invest in this stock is just to buy a little bit, hope it goes down more, and whenever the recession and everything clears up, the stock will go back to earning 13% a year, growing 13% a year. So there was an article on thestreet.com that Morningstar did this. They do the fair value, not the moat. They do a moat and fair value kind of search, and they say, what are the best stocks to own? And they mentioned some stocks that we went over, and they were concentrating on stocks that have competitive advantages and stocks that over the next 20 years have, like a moat that they could continue to grow. And what I did was I looked at some of these. We already went through Bud. Bud was a stock that basically was pretty inconsistent because, there's consumer's taste that you have to have factored in, and people get sick of it. a beer after a while and they go to some other kind of beverage. So we did that research two or 3 months ago, and it wasn't growing that much, like 5%, but they do have a good share of the market. But Berkshire Hathaway was one. If you're interested in a financial, it's a very diversified company, and you don't have to worry about a strong dollar because they're basically all U.S. based. They have diversified a bunch of companies that they own and they invest in. So it's an example of a stock that it's going down with the financials, but they're really maybe 30% financial company. I don't know. I think they have an insurance company. They're very diversified. If you're going to buy one stock and to be diversified, this is probably one of the most diversified stocks that has the greatest. I think Berkshire, Warren Buffett says it's one of the most safest stocks that you can buy and hold because it's so diversified that it's the chances of failure are pretty low. But it does sell for premiums and discounts over time, so you can time your purchase if you follow a certain rule. I'll go over later on. Here's another one, GSK. It's a drug company. It's a low PE. It has a dividend. Emerson Electric. It's actually a St. Louis company. I guess a lot of you know someone that works there. I'm going to go over that a little bit later. It's a conglomerate that does like air conditioning systems for companies, and they figure out automation and for big companies. So that's what they do, and they're very. I'll go over their financials later on. We already talked about Microsoft. We know that's diversified, and they have gaming, they have cloud, and they have, of course, a monopoly in the Windows, and Office. Disney is actually the stock. They're like a recovery stock. They're recovering from the pandemic because they had to shut down their cruise lines, their parks, etc. And now they're in their ESPN. There's no live sports for a while, so they were kind of recovering from all that. And they're doing streaming now, and they have a pretty much a moat. They have a not a moat, entertainment mode in some of the like Marvel and Star Wars. That is a really great franchise. They have great franchises. In Nike, we've been talking about that for a while. What I did was I concentrated on a couple of these just because I don't understand some of the ones as much. Like Comcast, they're a media company that does internet. We've been talking about Starbucks too, and the reason Starbucks might work in this environment, people consider it affordable luxury, like you pay $10 for a cup of coffee, but in bad times that makes you feel better. So that works in pretty much any environment. What I did was Morningstar basically went over each one of these, but they highlighted a couple. So I'm going to go over Morningstar's take on Berkshire Hathaway. They said they're diversified, and their overall risk profile is pretty low. So even though their stock price is going down now, they have very consistent, diversified businesses. Like they have a railroad, they have insurance, they have Geico, they have candy stores. So, but it's all related to the economy. So if the economy goes into recession, this stock will go down with it. But it's growing pretty much at 20% a year. Right now, I did the earnings estimates. They only go out 1 year. No one really understands Berkshire Hathaway that well, and there's not that many analysts, that cover it. They only go out 1 year, and they said they're growing at 10%. That forward PE is 1.18, so that means it's 1.8 times overvalued. But Berkshire Hathaway, Warren Buffett has always said that you have to look at the book value, and anytime it gets to its book value, then it's on sale, basically. And right now, the current price is $272, and the book value is $209. So it's 1.3 times the book value. And anytime the stock trades down to this book value of $209, Warren Buffett, he buys the stock back for the company. So you have this, that Warren's going to buy it at $209. So if it ever goes down there, then you have it's called a Warren Buffett put. But if you don't have any financial exposure in your portfolio, this could be something that compounds like 10% a year or more. It's been growing at 20% for the past 40 years or something. All right, so Morningstar's take on Emerson Electric. Okay, so this is a St. Louis-based company. They provide solutions for industrial, commercial, and residential markets like air conditioners, and it serves the oil, gas, and refining chemical power generation industries. Let me see. So this guy that wrote the article says there's a total addressable automation market, like maybe Amazon might be one of their customers, process manufacturing. And they said it's really undervalued. The fair value is 113 and they're trading at 78. So what I did was just for kicks, I went and I looked at this company, because every now and then you get these tips, but you got to really have it make sense for you. We have this profit margin was what we're looking for. We want something over 13, and return on equity has to be over 13, and that's good. The 4P is 14, and the PEG ratio is almost fairly valued right now. So it's 30, maybe 1.3 times overvalued according to Yahoo. So I looked at this, and they're only growing at like maybe 9%. So 7, 8, and maybe 9% average. And so if they have a 14 PE and a 9% growth, they're 1.5 times overvalued. But they have a dividend of 2.3%, so the total return is around 12%. And CFRA said that their fair value is around 74, which is right where they're at right now on the price. So it's not that exciting of a company to me. I mean, maybe they dropped in half from this. The great thing about this company is that'll allow you to diversify. If you get it for on sale, maybe the PEG ratio 0.5, then it's growing at maybe 8% consistently, then that'll be great. A long term, you can buy it and hold it, and it'll continue to grow. But right now it's a little pricey for me. I'm not that excited about that. I guess one thing, they're selling big systems, automation systems. You have to put a lot of money into equipment and things like that, so that the profit isn't as great. It's not an exciting story for me. When Google or a company like maybe Facebook or Google, they have servers, they have people, and that's it. You have advertisers. That's their business model, and it's not as much overhead. But let's look at another one just for fun. This is Emerson Electric. They said the fair value is 74, so it's overvalued. Fair value estimate for Morningstar is like a lot more than it is. Let's look at these numbers. I got these from Bank of America, the Merrill Edge. You can see that they're pretty inconsistent. I don't see them growing like 3, 4, 5, 6, 7, 8, 9. They're like all over the place for the free cash flow. Their earnings are they're not that consistent. I would expect for a stock that I'm interested in, I want them to be growing like in a straight line up, with some maybe 2020 going down a little bit maybe. But the revenue, that's not as consistent as I would want. So we'll wait for this to go on sale, and then we'll take a look at it again. Morningstar's take again. So this is we're looking at all these stocks that they recommended. One of them, let me see, where is it? There. We're looking at this list. We're going to look at Nike again, because it dropped 30, 40, 50%. I forget how much, but let's look at what people are saying this week. Morningstar said the fair value for the stock is 129, which is 30% more than it's trading at 88 now. This is an example of a quality company that's always sold for a premium, because they have the highest. They're the leader of the athletic apparel market, and near-term inventory and economic issues. So their biggest problem was their shoes were stuck on the boats trying to get in the port, and now they have this overload of shoes they got to sell, and that's like a one-time thing. So they're basically trading. Let me see. So they're the largest athletic footwear brand in all major categories. They dominate. For me, it's like the top tier brand. And they say they can maintain their share in pricing. Sometimes when you discount due to a temporary situation, that you might lose some value to your brand. Like if you see Nike's on sale for $10 on eBay, or maybe that's a cheap brand now, and then no one wants to buy it. So there's a trade-off for selling off your inventory. But this we've been talking about the direct-to-consumer network, and how you make a lot more if you sell direct to customer instead of giving Foot Locker 10% of the sale, whatever they sell it for. So, but this is an example of a stock that's growing at 20, 22, or 20%, let's say. If you divide these years by each other, you get around 20% earnings growth, and their PE ratio is 28. So they're trading around 1.4 times overvalued. But so I think they could go down 1.4 times less than where they're at now, but they hardly have ever sold at that multiple. So this is a good time to start putting small amounts in if you're interested in a stock you can buy and basically hold and grow at 20% over time. You see. So Yahoo Finance thinks that they're 3 times overvalued because they're only growing, like right now, maybe they're growing at maybe 10%. So if they're growing at 10% right now, then they're trading at a PE of 30. That means that they're that could be temporary. Sometimes Yahoo Finance uses this year's earnings for their calculation of the PEG ratio. So we have to balance out how did they get those numbers, and we have our formula and they have their formula, but we still think it's at least 1.5 times overvalued. All right, we already talked about this. We're still in despair. Now, people are getting possibly when you get towards the Christmas time, people are going to fear of missing out. FOMO. When that happens, people pile on, and then you have these mega rallies. But we don't know what's going to happen. We know the last 3 months of the year are usually good. This is the best